the new paradigm of investing beyond the 60-40 portfolio. For decades, modern portfolio theory, MPT, has shaped the way investors approach diversification, risk, and return. Developed by Harry Markowitz in the 1950s, MPT introduced the revolutionary concept that risk could be reduced, not simply by avoiding volatile assets, but by combining a variety of assets whose price movements are not perfectly correlated. This gave rise to what became the cornerstone of traditional investing, the 60-40 portfolio. A balanced allocation of 60% equities and 40% bonds was considered the gold standard for generations. It aimed to offer long-term growth from stocks while providing downside protection and income from bonds. Yet, as we enter a new era of global macroeconomic volatility, negative real interest rates, and rapid technological change, this model is showing its age. Simply put, the 60-40 strategy no longer adequately reflects the risk-reward dynamics of modern markets. Cracks in the traditional model. Recent years have laid bare the vulnerabilities of the 60-40 portfolio. Bonds, once the safe haven of portfolio construction, have struggled under the weight of inflation and rising interest rates. Equities, especially those tied to legacy industries, have been rocked by supply chain disruptions, geopolitical instability, and deglobalization trends. More crucially, the model ignores the emergence of new asset classes, ones that offer both uncorrelated returns and transformative potential. A new asset class, cryptocurrencies. Enter digital assets, led by Bitcoin and a broader class of cryptocurrencies. What began 15 years ago as a decentralized peer-to-peer payment system has evolved into a multifaceted financial ecosystem, featuring smart contracts, decentralized finance, DeFi, tokenized assets, and more. For years, retail investors have quietly accumulated crypto holdings, some for as long as 12 years since the early days of Bitcoin. These pioneers, once dismissed as speculative gamblers, are now seen as visionaries in light of the growing institutional acceptance of digital assets. Ric Edelman, often dubbed the Michael Jordan of registered investment advisors, has recognized this shift. In a recent white paper, Edelman advocates for a radical rethink of asset allocation, proposing that investors dedicate 10% to 40% of their portfolios to cryptocurrencies. His research suggests that this allocation is not only warranted by the risk-reward profile of digital assets, but may be essential for long-term growth. Importantly, Edelman emphasizes that crypto holdings should be diversified, mirroring a traditional stock portfolio. This means exposure to a blend of established cryptocurrencies like Bitcoin and Ethereum, as well as newer projects across various blockchain ecosystems. Commodities return to relevance. Alongside crypto, traditional commodities like gold and silver are reasserting their relevance. As inflation, fiat currency debasement, and geopolitical shocks grow more common, precious metals are once again viewed as reliable stores of value. Their role as part of a modern, diversified portfolio is more justified than ever, especially when paired with uncorrelated digital assets. A paradigm shift in what it means for retail investors. The implications of Edelman's proposal are profound. Should his model gain broad adoption among financial advisors, institutional investors, and retirement planners, the influx of capital into the crypto space could be staggering. The market may respond not incrementally, but violently, upwards. For long-term retail investors who have been involved in the crypto space for years, this would represent more than a return on investment. It would be a validation. The foresight to adopt digital assets early would finally be recognized by the mainstream financial world. We are witnessing a once-in-a-generation shift in investing. The new paradigm does not discard the lessons of modern portfolio theory. It evolves them. Diversification remains vital, but the definition of diverse has expanded. The future of investing lies not in clinging to outdated formulas, but in adapting to a world transformed by technology, decentralized finance, and new forms of value. Please like and subscribe. For more cryptocurrency content, visit MoneyStorm.